So coming into today's jobs report, my next guest was expecting 250,000 jobs, 225,000 in the private sector. Joining me now, KPMG Chief Economist Diane Swonk. And Diane, first of all, congratulations. The street was at 185,000. Why was your number so much higher, and how surprised are you at the actual print we saw?
Well, we actually were worried about the labor hoarding that's going on out there. Every January is a month that is the largest layoff month of the year. In the 2010s, we averaged 2.87 million layoffs every single January. Now, the strongest month of the year last year in 2023 was January, when we laid off only 2.5 million workers and we got 400,000 job gains. That means 400,000 more people got to keep their paychecks than they had previously. This year, we only got 2.6 million layoffs. Again, there's a lot of labor hoarding. Firms that worked really hard to get these workers are not willing to let them go. They're cutting back on hours worked. And there was a really bad storms across the country the week of the survey, but hours worked in the month fell down to their lowest level since 2011. So that was the one side of weakness. That said, we had a sharp acceleration in wages and upward revisions to wages in the fourth quarter as well, and upward revisions to job gains. So that really confirms the sort of fears that Jay Powell expressed at the press conference. He's not against growth, but he's worried that the labor market, excuse me, may not cool enough to keep service sector inflation down, and it could create too high of a floor under inflation to continue to see the improvements we need to see.
Yeah, and those wages, I think the irony there, of course, was that the wages came in, I think, is like 1,100, like 50 cents different, but less in January than in December. Now, there's another thing that you talked about and a couple of weeks ago. Anna Wong over at Bloomberg, she kind of floated this theory on low unemployment insurance payouts, right, being the reason why we're not seeing these initial jobless claims go higher. Instead, people are taking on more jobs. Multiple job holders hit a new record, I think, today. You pointed that out in your note as well. Is there something that we should be concerned about that? Is it a good thing? Is it a bad thing?
You know, since the turn of the century and the 2001 recession, we've seen multiple job holders increase as the unemployment rate decreased. And that actually has been a sign it's been consistent and pro-cyclical instead of counter-cyclical. Now, the 1990s were not like that. And I think that's really important. It's a major structural shift we saw at the turn of the century, and it's one that's gotten worse over time. That said, the people taking jobs for economic reasons, that they were forced to take part-time instead of full-time, it did move up in the month of January, but overall, it's come off very much from what we've seen earlier in the cycle, and that's good news. There are more people out there that are preferring to actually work part-time for non-economic reasons as well.
Wow. Hey, let's talk about the Fed a moment. You brought up the Fed. You know, and I saw you note again that you said that this week's decision was a hawkish hold, and you know, I'm wondering. So I don't know if Jay Powell got a glimpse of this number or not, but this hawkish hold, you know, what does it mean for the markets? Because Wall Street's still looking at 5-6 rate cuts. They still believe that they're still going to get what they want from the Fed this year.
They can't have their cake and eat it too. And I think what the Federal Reserve has made clear, and today's numbers certainly backed it up. He didn't have a pre-look at the numbers until last night.
Okay.
So he didn't have it when he did the press conference. That said, they do a lot of analysis at the Fed. They knew the seasonals were like they were, and they knew there was an upside risk. They also have been talking to businesses. And a lot of businesses are telling them things started to reaccelerate as the bond market rallied starting in November from the Fed's November Fed meeting. That's something they are watching very closely. We just came off of an extraordinarily strong year. The good news is we had a lot of productivity growth. The key question, which Powell sort of put to the sidelines, is whether or not the productivity gains we've seen are the start of something new or just a catch-up to some losses we had had earlier in the recovery.
Yeah.
If they're just a catch-up and we're just going to normalize, to use that word 8 times in the press conference, normalize, then we don't get the improvements in inflation with this kind of a sizzling hot job number with higher wages. If, in fact, we see productivity growth sustained, that's a different equation. And that would allow the Fed to cut more, but we're now at 3 rate cuts starting in June.
Before I let you go, and I've got just less than a minute, maybe 30 seconds, we got the final University of Michigan sentiment report for January. Just a monster rebounds everywhere. And I'm looking at these pluses year over year, month over month. Between this, the stock market exploding, the housing market being pretty strong, why is everyone written off the chance of a rebound in inflation, the pace of inflation? Doesn't this play a role in the wealth effect?
Think that's one of the. This plays well into wealth effects, absolutely, and it's one of the reasons the consumer's coming in hot. The 2-month improvement, December to January, in the Consumer University of Michigan Sentiment Index, that's the largest 2-month improvement since 1991, end of the first Gulf War.
Wow. Diane, thank you so much. Always appreciate having you on. Thank you.